If you take old age security at 65 instead of 70, you could be walking away from tens of thousands of dollars over your lifetime. But here's the part almost nobody talks about. For a lot of seniors, waiting is actually the wrong move, and it could cost them just as much or more. This isn't a simple wait is always better story, it's math, real math. And in the next 25 minutes, I'm going to walk you through exactly how that math works so that when you make this decision, you're making it with your eyes open instead of guessing. Here's why this matters right now. OAS is one of the biggest financial decisions most Canadian seniors will ever make, and it's a decision a lot of people make almost by accident. Many Canadians get automatically enrolled, some just take it the moment they turn 65 because that's what everyone else seems to do, and very few actually sit down and run the numbers. The problem is, this isn't a decision you can easily undo. Once you start receiving OAS, you can't simply reverse the clock and start deferring again. So if you're approaching 65, or you already are 65 and haven't started your OAS yet, this video could genuinely change how much money ends up in your pocket for the rest of your retirement. Before we go further, if you find value in straightforward, no-nonsense breakdowns of CPP, OAS, GIS, and other government benefits for Canadian seniors, go ahead and subscribe and turn on notifications. We publish this kind of practical, plain English content regularly, and you don't want to miss the updates that could affect your benefits. Now, let's talk about what you're actually going to get out of this video. First, we'll cover exactly how OAS deferral works, the mechanics of it, because a lot of people have heard the term delay OAS without really understanding what happens behind the scenes. Second, we'll look at the real numbers, using current publicly available Service Canada figures, so you can see what delaying actually looks like in dollars, not just percentages. Third, we're going to talk about who this strategy tends to help the most, and just as importantly, who it can actually hurt. Fourth, we'll cover how OAS deferral interacts with two other pieces of the puzzle that most videos completely ignore, the OAS recovery tax, sometimes called the clawback, and the Guaranteed Income Supplement, or GIS. And finally, we'll walk through the common mistakes seniors make with this decision, along with practical steps you can take this week to figure out what's right for you. There's a detail coming up around the 12-minute mark about how your spouse's OAS decision can actually affect your household's overall benefit picture. So make sure you stick around for that. Let's start with the basics, because if you're going to understand the math, you need to understand the mechanism first. Old Age Security, or OAS, is a monthly government pension available to Canadians who are 65 or older and meet the residency requirements. Unlike the Canada Pension Plan, OAS is not based on how much you contributed during your working years. It's based primarily on how long you've lived in Canada after the age of 18. To get the full OAS pension, you generally need 40 years of Canadian residency after turning 18. If you have fewer years, you may still qualify, but for a partial, prorated amount. Now here's where the deferral decision comes in. Most people think of 65 as the age you have to start OAS, but that's not actually true. You can choose to delay your OAS pension for up to 5 years, meaning you can push your start date all the way to age 70. And here's the incentive Service Canada offers for waiting. For every month you delay past 65, your OAS payment increases by 0.6%. That might not sound like much on its own, but multiply that out over 60 months, the full 5 years from 65 to 70, and you get a total increase of 36%. That's not 36% on your original monthly amount forever staying flat. It's a permanently higher monthly payment for as long as you live, starting whenever you decide to begin. So on the surface, this looks like a simple trade. Wait and get a bigger check every month for the rest of your life. And for some people, that's exactly the right call. But the real question isn't just will my monthly payment be bigger? The real question is, will I actually come out ahead in total dollars, given how long I might live, what else is going on with my income, and what I'm giving up by waiting? That's the version of this decision most videos skip, and it's the version we're going to walk through together. Let's get into the actual numbers, because vague percentages don't help anyone plan their retirement. As of the July to September 2026 quarter, the maximum OAS pension for someone aged 65 to 74 is $751.97 per month. Keep in mind that OAS amounts are reviewed and adjusted every quarter based on the Consumer Price Index, so this number moves slightly over time. Whatever your personal amount is, the same deferral principle applies. If you delay your OAS by a full 60 months, from 65 to 70, your monthly OAS pension will increase by 0.6% for each month you delay, up to a maximum of 36% at age 70. So using that $751.97 figure as an example, a 36% increase would bring the monthly amount up to roughly $1,022. Again, that's illustrative math based on current published maximums, and your actual personal amount will depend on your own residency history and, if applicable, your income level. Now here's the part where the real math starts. If you take OAS at 65 instead of waiting until 70, you receive 5 years of payments that someone who defers simply doesn't get. Using our example numbers, that's roughly $751.97 a month for 60 months, which adds up to somewhere around $45,000 received during those 5 years alone, money the person who delayed hasn't seen a cent of yet. Meanwhile, the person who deferred is receiving nothing for those 5 years, but from age 70 onward, they're getting a permanently higher monthly amount. So the question becomes, how many years does it take for the higher payments after 70 to catch up to, and then overtake the total amount the early starter has already banked? This is what's called the break-even age, and based on the standard deferral math, not accounting for taxes, clawbacks, or inflation adjustments, which we'll get to shortly, the break-even point for OAS deferral typically falls somewhere in the mid to late 80s, generally in the range of about age 85 to 87, depending on the exact numbers used. In other words, if you live past that break-even age, deferring OAS results in more total lifetime income. If you don't live past that age, taking OAS at 65 actually puts more money in your hands over your lifetime. There's another important detail many seniors overlook here. That break-even calculation assumes you're comparing apples to apples, dollars received today versus dollars received later, without adjusting for what money is worth to you right now versus decades from now. Some financial planners argue that money in your hand at 65, which you can invest, spend, or use to reduce debt, may be worth more to you today than a promise of higher payments starting at 70. Others argue the opposite, that a guaranteed, inflation-protected, government-backed income stream that grows permanently is worth more than the flexibility of having cash sooner. Both of these are legitimate ways to look at it, and neither is universally correct. It genuinely depends on your personal circumstances, which is exactly what we're going to dig into next. This decision affects essentially every Canadian approaching, or at age 65, who hasn't yet started their OAS pension. But it doesn't affect everyone equally, and that's the piece that gets lost in a lot of the online chatter about this topic. If you're in excellent health, you come from a family with a strong history of longevity, and you don't urgently need the income at 65, you're in the group that tends to benefit most from considering deferral. The math genuinely favors you if you're likely to live well past that mid to late 80s break-even point. On the other hand, if you have health concerns, a family history that suggests a shorter life expectancy, or you simply need the income now to cover your day-to-day living expenses, deferring may not make sense at all, no matter how attractive that 36% bump sounds on paper. Remember, if you defer and pass away before the break-even age, you and your estate never recover those 5 years of missed payments. There's no lump sum catch-up payment for OAS deferral the way there sometimes can be with certain CPP retroactive payments. There's also a group of Canadian seniors this decision affects in a very specific way, higher income retirees who are subject to the OAS recovery tax, commonly known as the clawback. For the current recovery period, that clawback applies once your net income crosses roughly $95,000, with the pension fully clawed back once income reaches somewhere north of $155,000 for those aged 65 to 74. If you know your income will be unusually high in the years right around 65, say, from a large RRF withdrawal, severance, or business sale, deferring OAS until your income settles down could mean you avoid handing a chunk of it right back to the government through the clawback. We'll go deeper into this in the next section because this is one of the most overlooked reasons some seniors choose to delay. And finally, this decision affects couples differently than it affects single seniors. If you're married or in a common law relationship, your OAS decision doesn't exist in isolation. It interacts with your spouse's CPP, OAS, and GIS eligibility, your household's combined tax situation, and potentially survivor benefits down the road. We're going to come back to that shortly because it's one of the most commonly missed factors in this entire conversation. Let's lay out the genuine benefits of deferring OAS to age 70, because there are real ones. The most obvious benefit is a permanently higher monthly income for the rest of your life. In a country where many seniors worry about outliving their savings, a guaranteed government-backed pension that increases by 36% and then continues to be indexed to inflation every quarter is a meaningful form of longevity insurance. If you're worried about running out of money in your 90s, a bigger OAS check starting at 70 is one of the most reliable ways to protect against that risk because unlike a savings account or an investment portfolio, it cannot be depleted and it cannot lose value in a market downturn. Deferring can also be a smart tax management tool. If you're still working part-time in your late 60s, running a small business, or drawing significant income from other pensions, adding OAS on top of that income during your peak earning years could push you into a higher tax bracket or trigger the OAS clawback. By deferring, you delay that additional taxable income until a point when your overall income may be lower, potentially reducing or eliminating exposure to the clawback altogether. There's also a quieter benefit that doesn't get discussed enough: psychological security. Knowing that a bigger inflation-protected check is coming later can reduce financial anxiety for some retirees, especially those who have other resources to lean on in the meantime. But let's be honest about the risks too, because a responsible conversation about this topic has to include them. The most obvious risk is the one we already touched on. If you don't live to the break-even age, you come out behind in total lifetime dollars compared to taking OAS at 65. Nobody has a crystal ball, and health can change quickly and unpredictably. There's also an opportunity cost to consider. Money you could have received starting at 65 and potentially invested, used to pay down debt, or simply enjoyed during your early, healthier retirement years is money you don't have access to while you're deferring. Some retirees find that having less flexible income in their most active retirement years, when they're most likely to travel, help family, or pursue hobbies, isn't worth a bigger check decades down the road when their lifestyle needs may look very different. And here's a risk that's rarely mentioned. Deferring OAS also means deferring GIS eligibility conversations, since GIS is only available to people who are already receiving OAS. If you're a lower income senior who might actually qualify for GIS at 65, delaying your OAS pension means delaying your GIS as well, and for some people in that income bracket, the GIS payments they'd give up by waiting can outweigh the benefit of a larger OAS check later. This is a critical point, and it's one we'll expand on in the mistakes section coming up. There's another important detail many seniors overlook, and it ties back to something I mentioned earlier about couples. If one spouse defers OAS and the other doesn't, it can change how the household qualifies for the allowance, which is a benefit available to the 60 to 64-year-old spouse or common law partner of someone receiving GIS. Timing matters more than people realize when there are two people's benefits interacting with each other in the same household. If you're finding this breakdown helpful, this is a good moment to hit subscribe if you haven't already, because we're about to get into the specific mistakes that cost Canadian seniors real money. And you'll want to make sure you catch our future videos on GIS, CPP timing, and clawback strategies too. Let's talk about the actual rules and mechanics you need to know if you're considering deferral. First, the deferral window is capped at 5 years. You can delay your OAS start date up to, but not beyond, age 70. Waiting past 70 provides no additional increase. The 36% maximum is reached at exactly that point, so there's no financial reason to wait any longer than that. Second, if you are not automatically enrolled, or if you are automatically enrolled but want to defer, you need to actively communicate that choice to Service Canada. Many Canadians are auto-enrolled based on information Service Canada already has on file, and you'll typically receive a letter around age 64 telling you this. If you get that letter and you want to defer, you must respond and decline the automatic enrollment before your payments begin, or complete the appropriate section of the enrollment letter to indicate you want to delay. If you were not automatically enrolled, you simply choose not to apply yet and apply later when you're ready to start. Third, once you do decide to start receiving OAS after deferring, you generally need to apply, since deferral isn't something that resolves itself automatically. You can do this through your My Service Canada account online or through a paper application. It's worth applying a few months before the date you want your payments to start, since processing takes time and OAS payments cannot generally be made retroactive for periods during which you chose to defer. Fourth, remember that OAS amounts are reviewed and adjusted every quarter, January, April, July, and October, based on changes to the Consumer Price Index. This means the specific dollar figures you see in any video, including this one, are a snapshot in time. The percentage-based deferral increase of 0.6% per month up to 36% at age 70 is a fixed program rule and does not change quarter to quarter, but the base amount it's applied to does move with inflation. Always check your current personalized numbers through your My Service Canada account rather than relying on generic figures for your specific planning decisions. Fifth, and this is a rule people frequently get wrong, the OAS recovery tax threshold and the OAS deferral decision are two completely separate mechanisms, but they interact. The recovery tax is based on your net world income in a given tax year, and OAS payments themselves count as part of that income. For the current recovery period, the threshold sits at roughly $95,000 in net income for someone aged 65 to 74, with the pension being fully clawed back somewhere past $155,000. If your income is comfortably below that threshold, the clawback likely won't factor into your deferral decision at all. But if you're near or above it, deferral can be a meaningful strategy to reduce your exposure during your highest income years. Let's talk about where seniors go wrong with this decision, because these mistakes are avoidable, and avoiding them could genuinely be worth thousands of dollars. The first mistake is treating this as an all or nothing, one-size-fits-all decision based on something you heard from a friend, a forum, or a general rule of thumb. The right answer for your neighbor who may have a completely different health profile, income situation, and retirement savings is not automatically the right answer for you. This is a personal finance decision that deserves personal math, not a borrowed conclusion. The second mistake, and this one is huge, is deferring OAS without checking whether you're eligible for GIS. GIS is only paid to people who are already receiving OAS. GIS is only paid to people who are already receiving OAS, so if your income is low enough that you'd likely qualify for a meaningful GIS payment at 65, deferring your OAS pension means you're also giving up months or years of GIS payments you could have been receiving. For lower income seniors, this can completely flip the math because GIS payments can be substantial, and giving them up for years just to get a larger OAS check starting later often doesn't make financial sense. If your income is modest, this is the single most important thing to check before deciding to defer. The third mistake is ignoring health and family history entirely and making the decision purely based on percentages. A 36% increase sounds impressive on a spreadsheet, but if there are known health conditions or a family history that suggests a shorter life expectancy, the break-even math simply may never play out in your favor. This isn't a comfortable thing to think about, but it's an honest and necessary part of the calculation. The fourth mistake is not accounting for the clawback correctly. Some seniors defer OAS assuming it will automatically help them avoid the recovery tax without actually running their expected income for the years in question. If your income is going to remain well below the threshold regardless of when you start OAS, deferring purely for clawback reasons may not provide any real benefit, and you could simply be giving up years of guaranteed income for no tax advantage at all. The fifth mistake is forgetting that this decision doesn't happen in a vacuum if you're part of a couple. Some seniors optimize their own OAS timing perfectly, but don't consider how it affects their spouse's potential eligibility for the allowance, or how their combined household income and tax situation shifts based on who starts which benefit and when. This is exactly the detail I promised you back near the beginning of the video. If one spouse has a much lower income, that couple's overall benefit picture, including GIS and the allowance, can look very different depending on the sequencing of both partners' CPP and OAS decisions. This is genuinely worth sitting down with a benefits calculator or a qualified advisor to map out as a household rather than as two separate individual decisions. The sixth mistake is failing to notify Service Canada in time if you were auto-enrolled but wanted to defer. If your enrollment letter arrives and you miss the window to decline it, your OAS payments may simply begin at 65 by default, and reversing that after the fact isn't a simple undo. It typically involves formally requesting to cancel or postpone your pension within a specific window after payments start, and there are rules around repaying any amounts already received. It's far cleaner to make your decision proactively rather than reactively. So what should you actually do with all of this information? Let's break it down into concrete, doable steps. Step 1. Log into your My Service Canada account and confirm your personal, current OAS estimate, both what you'd receive starting at 65 and, if the tool provides it, what your deferred amount would look like at various later ages. Don't rely on generic averages from any video, including this one. Your own residency history and income situation make your numbers unique to you. Step 2. Honestly assess your income picture for the years between 65 and whatever age you might defer to. Are you still working? Do you have significant RRIF withdrawals, rental income, or investment income that could push you close to or past the clawback threshold? If your income is comfortably low, the clawback likely isn't a major factor in your decision. If it's high or unpredictable, that's a strong signal to look more closely at deferral as a tax timing tool. Step 3. Check whether you might be eligible for GIS if you started OAS at 65. If your income is modest, this step alone could change your entire decision. GIS eligibility and payment amounts can be estimated through the same Service Canada tools, and this is genuinely one of the most overlooked factors in the entire deferral conversation. Step 4. Have an honest conversation with yourself, and ideally with your doctor or your family, about your general health outlook and family longevity history. This isn't about predicting the future with certainty. Nobody can do that, but it's about making a reasonably informed judgment about whether you're more likely to be in the group that benefits from waiting past that mid to late 80s break-even range, or the group that's better served by taking the income sooner. Step 5. If you're part of a couple, sit down together and look at both of your CPP and OAS timing decisions as one combined household strategy, not two separate individual choices. Consider how your decisions affect each other's potential GIS or allowance eligibility and how your combined tax situation shifts based on sequencing. Step 6. If your situation involves significant income, a business, investment property, or anything beyond a straightforward pension and modest savings, this is genuinely a good moment to consult a fee-for-service financial planner or accountant who can run personalized projections. The stakes here are large enough and the decision is permanent enough that a bit of professional guidance can pay for itself many times over. Step 7. Whatever you decide, document your reasoning. Write down why you chose to take OAS at 65, or why you chose to defer, and what assumptions you used. Revisit that reasoning if your circumstances change significantly. For example, if you go back to work part-time, your health changes, or you receive an inheritance. This isn't a decision you can change after you start receiving payments in most cases, so getting it right up front matters. Let's bring this all together. Deferring OAS from 65 to 70 increases your monthly payment by 0.6% for every month you wait, adding up to a maximum of 36% if you wait the full 5 years. That's a real meaningful increase, and for the right person, it provides valuable longevity protection and a bigger permanently indexed income stream later in life. But the break-even point for that decision typically falls somewhere in the mid to late 80s, and that means this strategy genuinely favors people who are in good health, come from families with longer life expectancies, don't urgently need the income at 65, and aren't likely to qualify for meaningful GIS payments in the meantime. For lower-income seniors who might qualify for GIS, or for anyone who needs the income now, taking OAS at 65 is very often the smarter and more financially sound choice, regardless of how attractive that 36% headline number sounds. This decision also isn't just about you in isolation. It interacts with the OAS clawback if your income is high, with GIS if your income is modest, and with your spouse's benefits if you're part of a couple. The right answer really does depend on your specific numbers, your specific health picture, and your specific household situation, not on a blanket rule that applies to everyone equally. There is no universally correct answer to whether you should delay OAS until 70. There's only the answer that fits your income, your health, your family history, and your household situation. The seniors who come out ahead on this decision aren't the ones who followed a rule of thumb, they're the ones who took the time to check their own numbers, understood how deferral interacts with GIS and the clawback, and made a deliberate, informed choice rather than a default one. If this video helped clarify how OAS deferral actually works, do us a favor and subscribe, turn on notifications, and share it with a friend or family member who's approaching this decision themselves. We publish regular, straightforward breakdowns of CPP, OAS, GIS, and other Government of Canada retirement benefits specifically for Canadian seniors who want clear answers without the runaround. Stay informed, check your own numbers through your My Service Canada account, and make this decision on your terms with the full picture in front of you. Thanks for watching, and we'll see you in the next one.